Hey guys, I'm Tahir.
I'm Mike.
I'm Valentina.
And I'm Nate, and today we're going to be pitching Cameco Corporation. So starting with the business overview, Cameco is one of the largest publicly traded uranium producers in the world, and it's headquartered in Saskatchewan, Canada. What separates it from its peers is its unique and integrated business model, and it has its hand in almost every part of the nuclear value chain. So breaking down its different business segments, they can be categorized into three. So its core uranium productions generated roughly $2.1 billion in revenue last year from its Tier 1 assets, which are among the highest grade, lowest cost mines in the world. Second, we have fuel services, which generated roughly $402 million in revenue last year. And then finally, we have Westinghouse, a 49% stake in a company that grants it exposure to a business generating $1.6 billion in revenue through reactor services and reactor build-out. And here's a good visual of its business segments, a nice breakdown. So at the top, we can see the Tier 1 uranium assets with the Tier 2 under them. And on the right, we can see their fuel services assets as well as their Westinghouse investment and their investment in GLE, which is another minority investment, and that is global laser enrichment, and it's basically a technology that enriches uranium using lasers. And so now their positioning relative to peers, Cameco is really the only company in the uranium industry that has its hand in all segments of the uranium, the nuclear fuel cycle. Most companies have their hand in just one of these segments, whether it's mining, milling, conversion, or reactor build-out. And so Cameco can really profit from all portions of that nuclear fuel cycle. And so wrapping up competitive positioning, global nuclear generation is expected to increase 3.5% each year over the next 10 years. And long-term contracting is really accelerating after years of underinvestment. So with Cameco's large spend, they're really positioned well to benefit from this estimated growth. And so now I can pass it to Mike to go over our thesis and risk factors.
Thanks, Nate. So the thesis here is really just a simple supply and demand story. The uranium market right now is operating at about a 30 million pound deficit annually, and it's only a $205 million market, so very major, and also there's really no clear path for this to change at all. In 2025, there were some very large supply-side failures at Cameco junior miners in NextGen. And the other thing is that for new miners to come in and build new mines and add supply, the long-term contract prices need to actually rise to about $100 to $120. So there's a little bit of a stalemate there. And why is Cameco well positioned because of this? So one, they have the biggest uranium mine in the world, McArthur River, and they can flex that production there to take advantage of the supply deficit. Two, long-term contracts. They're very well set with stability for the long term because the revenue is pretty much accounted for. They're a Western supplier, which is good because a lot of uranium comes out of Russia, Kazakhstan, so geopolitically it's not a great spot right now. And also contracting, so utilities need to have about 3 to 5 years of contracts, uranium contracts at any given time, and they're about to run out of the secondary supply, so very soon there'll be a real sort of growth catalyst when they have to renew. And a few more things, you guys are all familiar with what AI is doing for power and energy demand right now, and also reactor construction. So lots of reactors are being constructed globally at the moment. Another interesting thing is that the spot price of uranium was $136 per pound in 2007. Right now it's much lower at only about 90, so there's it's very feasible for it to surpass that very greatly. Some risks and mitigants, I'll go over just a couple of these, but policy risk is a big one. I don't really see the pendulum swinging back with just how much capital has been committed to nuclear build-out and also big tech and just sentiment globally around nuclear. And also macro volatility. Recently, Cameco drew down about 17% on a larger market drawdown. But that marks, I think, a great entry point, honestly, because it's a halo stock. It's not at all vulnerable to tech or AI making it obsolete. So it's in a great position going forward. Now I'll pass it off to Valentina, financial analysis.
Thanks, Mike. Cameco's financials tell a story of accelerating profitability. Revenue has compounded at 42% annually since 2022, and this was driven by the Westinghouse acquisition and also rising uranium contract prices. Looking forward, revenue grows from $4.1 billion in 2025 to $5.2 billion in 2027. EBITDA margins stabilize around 55%, and EPS hits $5.45 by 2027. Zooming in on our revenue build, Westinghouse grew from 0% to nearly 39% of total revenue in just 2 years, and this is diversifying beyond uranium spot prices. And looking at our base case DCF, all 3 segments grow 10 to 19% annually through 2030, with uranium leading this as contracts reprice upward. And last slide, Cameco's balance sheet supports our thesis. The company has over $1.6 billion in total liquidity. Also, Westinghouse and Inkai have generated $307.5 million in cash distributions in 2025. So with all this being said, Cameco has the capacity to expand and return capital at the same time. Now I'll pass it to Tahir for our evaluation.
Thank you. Now, our DCF was based on 2 main assumptions: revenue growth, which would go from 10% to between 13% or 19% based on the 3 cases, and EBIT margin, which would grow to nearly 55% or 51% based on the case you're looking at. And so, which outputs us across the 3 cases a meaningful premium. We used the 9.5% WACC, which was mainly driven from the cost of equity, as Cameco barely has any debt. Their debt is about just 2% of their capital structure, with a 20x EBITDA multiple. The mining industry usually trades at around 15x EBITDA, and we gave Cameco the premium due to their vertical integration in the nuclear fuel cycle. Sensitivity analysis across the base and the bear case, so this is just telling us this is not just an EBITDA and a WACC assumption. They're doing great based on the revenue and the margin assumptions. And we did a comp analysis. We used the biggest uranium mining company. We used BWX, one of the biggest US nuclear fuel services company, and a small uranium enrichment company, which gives us a nearly 20% blended upside, which gives us to our final blended price of $155 from a current $112, 38% upside, weighted equally among each method. Thank you.
How many plants are planned or under construction in the U.S.?
Globally, 70 are being constructed right now, with I think 150 planned. In the United States alone, do we have that number?
United States.
Yeah, I believe so.
2?
Yeah, I believe so.
So China accounts for, what is that, 90% of global demand?
Large portion, yeah.
Large portion. But another thing that's not really factored into that graph is there's a lot of plants that are being not constructed but like revitalized, like 3 Mile Island in the United States and a few others, so those wouldn't be accounted for.
Can you explain the Westinghouse acquisition and how it gets accounted for?
So, you mean within their balance sheet, how it gets accounted for?
An income statement.
So, they actually own a minority stake. It's 49%. So, it's not reported on their income statements or balance sheets. It's Brookfield owns the other 51%, so they account for that revenue. But still, I mean, it's a cutting edge company that if SMR, which is small modular reactors, which are new technology, if they become more economic at scale and practical, that will mean massive returns for Cameco and also more diversified revenue stream.
Who owns the other part?
Brookfield.
Brookfield, okay.
Brookfield.
Canadian company, yeah. Because it was a bankrupt company, right? Westinghouse.
Westinghouse? Yeah, I believe there's a lot of history there. I think they used to be pretty broad within energy, but now they're very focused on just nuclear. They mostly just build facilities and are working on developing SMRs also.
And why do you think it deserves such a huge premium to the other companies in the group? I mean, it trades at 12 times EBITDA versus 6 times for a lot of the rest of the group.
Yeah, I mean, Cameco is the only vertically integrated company among the in the nuclear fuel cycle. I mean, they're the second largest uranium mining company. The first is a Kazakhstani company. They're just purely a uranium mining company. BWX is purely a nuclear fuel services. And EU is purely a uranium enrichment company. And Cameco operates across all the 3 segments. I mean, and they're the only company out there that does it, and that's why we give it that premium.
Another thing to note is geographically, they're the only very prominent Western uranium company. Like the other ones that you just mentioned are Kazakhstan and Russia also has big roots, so that's risky from an investing point of view, just geopolitically, which is also another reason for the premium.
What does BWX do?
They're
Not do?
They provide contracts mainly for the government in the nuclear fuel services.
So they buy from Cameco, from Kazakh, whatever it is, and process the uranium?
Yeah, a lot of these companies are very interconnected. Another thing that Cameco has a bottleneck on supply-wise is conversion, which uranium goes through a 3-step process to become the actual grade that's used in utilities, but conversion facilities owned by Cameco, a lot of uranium companies will actually contract them, and there's I think a 3 to 5 year backlog right now on conversion.
You mentioned that contracts were going to get priced upward. What is the contract? Talk us through that. Why is there a lag time on that for repricing?
So because uranium spot prices are at that $90 mark, and we think that they will go back to old levels, they'll just reprice at the market price.
Yeah, and another thing to add is there's a bit of a supply cliff that these uranium facilities are encountering right now. Do you have the graph of the secondary supply? It's up a few slides, but many of these utilities have a secondary supply of just excess uranium from years prior, and they're starting to run out of that, which means that they're going to need to cover fast, and that to us is a tailwind, which would boost the price. It's actually
It's
up
in
a
the
couple.
thesis.
No, it's down.
The mines have long useful
That
lives.
graph. What was that?
The mines have long lives, or are they almost out of uranium?
Yeah, so, I mean, it's dependent. I believe that there was a lot of mines that are going to expire soon just because in the 70s there was a big nuclear resurgence and then it sort of trickled off a little bit. But building a new mine is obviously a massive capital intensive process, and the economics are there, but not as justified as it once these contract prices start to rise a little bit. So it's a bit of a stalemate between the suppliers and the utilities, which is why we believe that the price is going to have to come up.
Why did Next Gen work? Why did they delay their expansion?
I think one of the biggest limiting factors there is policy. There's a lot of red tape and building a nuclear facility, as one might imagine. Also, supply chain issues. I think tariffs were a pretty big headwind for that as well.
There was, on one of these slides around here, there was talk of being able to increase production around from 15 to 25 million pounds. I don't recall which one.
It would go up one.
Yeah. 15 to 25 million pounds per year. How long does that take to get spun up?
I can't give you all the details. I mean, I would assume it's not instantaneous, right? But I know that there is excess capacity at that mine because they're pretty intentional on how much they actually bring into the market. At one time, it's a little bit like oil and OPEC, how they sort of bring in supply. But from what I read about it, it's not a non-feasible thing at all.
And then on a couple slides back, you had a 3.5% assumption on, right here. That sounds low.
Where was that?
The low nuclear generation is expected to grow 3.5%. Where did y'all get that? And why might that be
So
too low?
we took that from a UBS equity research report. That was an estimate that they had, and it is on the lower end just to be a bit more conservative. But it's still like with that. Sorry.
Yeah, you're good.